The UK's latest warning just isn't about their economy, it's a global wake-up call, and as you're about to see, the consequences could be devastating. I'm your host, Steve Van Metre, and thanks for joining me today. And our show today, cracks in the UK labor market are already showing, and what happens next is a warning to workers all around the world. Now let's head over to Bloomberg, where we picked today's story up with a headline as UK wage growth hits 6-month high. And according to the political elites, this should be fantastic news. This should be signs that the labor market is turning around, that higher wages will lead to higher inflation as those who have a paycheck will be spending more. But that's just part of the problem. Those who are getting paychecks is shrinking. And fast. Data based on tax records show the number of employees on payroll at the lowest level in over a year after falling by 47,000 in December, the largest drop since the end of 2020 when the country was under COVID restrictions. And this is a warning to workers all around the world. Everybody's looking to get higher pay increases, and the problem is it's coming at the sacrifice of jobs, and this is going to spread all over the world and very quickly. The looser labor market will reinforce the odds of a February rate cut. Well, at least that's the expectation. The labor market is showing signs of wear and tear as weak demand, there's a key word, weak demand, and higher payroll costs start to weigh on employment. So what happens here, as demand goes down, margins get squeezed. And so what employers do is they look to cut expenses. The problem is they've cut all the expenses they can, labor now being the last one. So what happens is those who do keep their jobs, well, they get a pay increase. The problem is too many other people are losing their jobs, and this means the consequences to the economy and to the labor market are going to be devastating. And what we see happening in the UK is a warning to workers all over the world. Now let's turn to some US data as we look at average hourly earnings of production and non-supervisory employees. This shown in blue on a year-over-year rate of change against the unemployment rate in red. And let's go back to 2000, and what do we see as the economy's booming? Well, as expected, you see wage growth is rising, and then it peaks somewhere right around the late 2000. It starts to roll over. What happens, as you can see, it impacts the labor market. So while those who are working still get pay increases, there are many people hitting the unemployment line, and then you see the unemployment rate rise. This is an indication of what happens when demand falls out in an economy. You see the same thing happen around 2007. Wage growth right there starts to peak and roll over, but it remains relatively high even going through the global financial crisis. The problem is those who benefited from it were few because many Americans were hitting the unemployment line at rising numbers. And let's fast forward to where we're at now. We see wage growth slowing, but historically it remains at relatively high levels. But as you can see in the past, that doesn't matter much because what is happening, again, companies are getting squeezed at the margin here. They're looking to cut expenses. They're seeing demand go down. That means they're being forced to cut employees, and that's why we're seeing the unemployment rate slowly move higher. Now, the Fed will have you convinced that this is it. It's not going to go any higher. And perhaps when we get the next payroll report, it won't. But based on what we're seeing in the trend in data, when you see average hourly earnings decline and demand drop, it's only a matter of time before we see the unemployment rate rise, which is why what's happening to UK workers right now is a warning to those all over the world. Let's take a look at some more data as we can try to navigate the issue of demand falling out. And it's very clear when we add the consumer price index in red, that shown on a year-over-year rate of change against average hourly earnings of that, again, of production and non-supervisory employees. And we can clearly see that when price growth starts to slow down, it's an indication that demand is waning. You see that happen again right around 2000. So we can see the effects of what happens to slowing wage growth and rising unemployment amidst a slowdown in demand. You get a recession. It's very clear what happens. And once again, that happens right around 2007 into 2008. We see the consumer price index fell. Now keep in mind, it surged higher due to energy costs. That broke the back of U.S. consumers. Demand then plunged during the global financial crisis and unemployment rate skyrocketed. We saw another slowdown. Remember, this was supposed to be a global recession that was going to happen right around 2015 into 2016. You can see demand from U.S. consumers plunge as consumer prices fell. We see wage growth slowed, but yet things turned around just in time. But look where we're at now. We see once again demand going down. Now, what did we get out of the factory data just the other day? We found out from S&P Global that input costs were rising as well as output costs. So what's going to face U.S. consumers is rising prices. The problem is their wage growth is slowing. Now, remember, just last week, we got some very interesting data on the labor market that said the year-over-year rate of change in payroll growth had slumped to 1%. Now, mind you, the data we're looking at in red is the official government data. But if it has fallen that much, it means that U.S. consumers cannot afford these higher prices. Demand is going to go down. Companies, again, squeezed at the margin. They're going to face the ultimate choice, and that is to lay off employees to keep in business. Exactly what we're seeing in the UK, which is why it's a warning to the world. But in further signs of weakening activity, vacancies dropped by 24,000 in the 3 months to December, compared with the previous quarter to 812,000, the 30th consecutive drop. So at the same time, employers are laying people off and they're cutting their wage growth back. What we're seeing is vacancies. That means new job openings. They're closing the door on them. They're going away. And it makes perfect sense, because if you did need workers, you would keep the ones you have. In this case, they're getting rid of vacancies in a big way. We're going to look at the U.S. data here in a moment, because the unemployment rate also edged up to 4.4% in the 3 months through November from 4.3% in the 3 months through October. Although officials have cautioned over the accuracy of the UK jobless data. Well, that's because it's not printing the direction they want. Because again, the experts see when they get wage growth, that means workers are going to go out and spend, and they're going to spend big, and that's going to drive inflation and move goods off the shelves. That means, of course, wholesalers are going to run out of inventory as well. Manufacturers are going to get a bunch of new orders, and that's going to drive new hiring. The problem is, when you have a declining workforce, it's exactly what's happening in the UK. Rising wages, well, they're meaningless. Let's take a look at some U.S. data here. Once again, we have the job openings and labor turnover survey in blue. That's called the JOLTS. It gives the unemployment rate in red. And you can see that as employers are laying people off, well, those vacancies, those open positions, they go away. Now, one of the problems with the JOLTS survey is only about 30% of the companies respond, making it a highly inaccurate survey. But nevertheless, it still gives us perspective for those who did respond that vacancies are plunging. Now, we saw after the election the vacancies did rise. We can note that this is likely transitory based on consumer spending. And what if consumers don't come out and spend big over the holiday season, as we know they didn't? Well, it means these vacancies are going to get shut down very, very quickly. But again, it's all about rising unemployment. If that continues to trend up, look for employers to close out those vacancies. And the rise in pay growth is expected to be short-lived as the labor market faces headwinds. So again, companies are forced to give out wage increases to the employees they want to keep. And then they turn around and said, well, don't worry, future wage increases aren't going to be so generous, because employers know when there's a lot of available work on the unemployment line, they don't have to give out big wage increases to their existing workforce. And it makes sense, because those who do have a job, well, they know people that have lost their job. And if those on the unemployment line have been there for months on end, as we're seeing here in the U.S., well, those who are working aren't going to complain when they get any form of raise. She pointed to a rise in unemployment and said the increase in wage growth was, quote, largely due to base effects, and we expect growth to trend downward over the coming year with a backdrop of slowing labor market activity. And that's exactly my point, because if demand isn't there, you don't have to give out big wage increases. Of course, we know where some of these increases are coming from. It's the sacrifice of jobs. You lay some employees off, you give the rest of them pay increases. But as demand continues to fall and price pressures slow, well, you don't have the money to give out big pay increases. And the best part is, a lot of employees don't expect it, because there is a point where they see demand plunging and they'd rather keep their job than ask their boss for a big raise. But one thing we do want to see is you making more money. My subscribers are making a ton of money in trading. I'm making a bunch of money, and you can too. Let's check this out. At the close of business Friday, our CTA Timer Pro, we trade against the machines. Look at this. We walked into the weekend with 12 open trades. 8 of them are up. Could you imagine trading and sitting on a 75% win rate. Well, let's take a look at Momentum Timer Pro. We trade the technical indicators, but we do it with a proprietary overlay. We walked into the weekend, 10 open trades, all of them up. That's a 100% win rate. Now imagine the kind of money you could be making in the market with that kind of confidence. Now what happens every day? We run the reports on machine positioning. We try to position our subscribers ahead of big buying in machines. We give them notes along with the report every day. We tell them which trades we think they should take, and then we execute and show you how to make money. We tell you when to get out of these trades as well. We do the same thing for our Momentum Timer Pro subscribers when we trade against those momentum signals. And here's a great part. You get the reports. I give you all the signals. I go through and tell you these are the trades I think you should take and why. I give you full back-tested data that validates our signals work. We give you risk control levels so you don't have to sit there and monitor your trades all the time. It gets you stopped out even if you're at work. That way you can lock in those gains. We give you a weekly update as well and a 30-day free trial. You grab the links in the description below, and here's the best part. I'll disclose exactly what I'm trading, when I'm trading, what I'm buying, what I'm selling. You can follow along right alongside with me if you want. Again, grab those links in the description below. Governor Andrew Bailey has signaled a cautious approach to further easing. Meanwhile, we're signaling all green lights when it comes to trading. Officials have played down the recent uptick in wage growth, with surveys showing the labor market cooling in response to a faltering economy. And this is a great point. They're waking up to the reality is that wage growth isn't the answer. And that's what we've been hearing for so long. Look at the wage growth. It's rising or it's continuing to trend up. But bottom line is the bigger picture is it's slowing. And now we're finally seeing the political elites wake up to the reality is that the global economy is headed into a recession. UK now being in a clear path to that. And look at the knockoff effects from this. A surprise UK retail sales drops fuels economic growth worries, and for good reason. When workers hit the unemployment line and those who do have a job see less income against higher prices, well, it's going to impact the retail sales numbers. We said this was coming. We're seeing it in the U.S. data, but look what's happening in the U.K. Again, warning to the world here as the figures add to an anecdotal evidence of disappointing Christmas for retailers. Despite growing real incomes, that's inflation-adjusted incomes, households are in a cautious mood amid warnings of an inflation resurgence and expectations of slower declines in borrowing costs. But that's not it. Households already know that inflation is too high. They've known this for a while, and it has nothing to do with rate cuts, because if rate cuts actually mattered, what we see all across the world is, hey, we cut rates a couple times, which central bankers did, and it didn't lead to an increase in consumption. So we know it doesn't work. We know they're not effective. The reason workers are cautious has nothing to do with those two issues. It has everything to do with the fact they're worried about losing their job. And here you can see the evidence of this as we back to the U.S. data. Let's look at real retail sales against that's inflation adjusted. That's shown in blue on a year-over-year rate change against the U3 unemployment rate in red. And what do we see? That as unemployment rate rises, which makes perfect sense, because when people lose their jobs, they go on unemployment and their incomes go down quite substantially. And they still have rent to pay. They still have food to buy, and those prices are going up. And they still have energy to buy, and we know prices on that are going up, not to mention massive debt service costs, leaving very little on the discretionary side. And what do we expect to see? And we do very clearly real retail sales here starting right around 1999. They slow down. The labor market unwinds right into a recession. And again, we see that happen around 2006. We see this long slowdown in real retail sales. Eventually, it impacts the labor market because, again, if you're a business and sales are slowing and you're getting squeezed at the margin, you cut expenses and then you cut employees, because if you're not driving a lot of business, you certainly don't need people staying around doing nothing. And again, right into the global financial crisis. And look at now, businesses have been hanging on for 3 years with largely negative real retail sales. They haven't laid off big yet, but we know that is coming eventually. If there isn't a turnaround here very quickly, watch out below, because scars from the cost of living crisis saw fragile consumer confidence persist in December as shoppers adapt to higher prices, prioritizing value during the Christmas period. And that's what they want you to believe, is that consumers, well, they're just more savvy now. They're watching how they spend their money. No, the reality is they want to buy a bunch of stuff, and they know their money doesn't go as far. It's not about value. It's about the fact that they cannot afford to buy the goods they want because inflation is too high and wage growth is too slow, and not as many people have jobs here. That is the real issue. And we talk about consumer confidence. We mentioned this last week. And what do we say? that big driver of consumer confidence is the labor market. Consumers lose confidence when they lose their job, or even worse, they see that their friends are losing their job and they're not getting back on the employment track, meaning the risk to them is high if they lose their job as well. That's a big way to get confidence to plunge. And economists are becoming increasingly worried, which is a great thing, that the UK is facing a stagflationary trap where high inflation meets low growth to inflict a large amount of pain on businesses and households. And yes, it does. But notice, they're getting worried. But what are they doing about it? Absolutely nothing, because all these political elites, these government officials, there's nothing they can do to change what's happening. And when you get these periods of stagflation, which is rising unemployment and rising consumer prices, do you know what happens each and every time? We go into recession, my friends. We don't need a chart to look at that. We know this for a fact. And then what happens to prices? They come down and unemployment continues to surge. You end stagflation with an all-out recession. And as we now turn to the U.S. consumer, we can see why the spending here isn't likely to improve anytime soon, as Americans are carrying bigger credit card balances, and the problem is rates are near some of the highest in history, and they're spending more on credit cards and carrying bigger balance month to month, with the average credit card interest rate somewhere over 20%. And JP Morgan Chase, the biggest U.S. bank, said its most recent quarterly report that saw higher revolving credit card balances, or the amount people don't pay off monthly. Capital One also said the proportion of people making just the minimum payment is above pre-pandemic levels. So what does that tell us? Before the pandemic, we already saw that the U.S. economy was slowing and heading into recession. Now what they're saying is, wait a minute, people have bigger balances, they're paying more in interest, and more people are making the minimum payment. That's because they cannot afford to pay down their credit cards. Now, what's going to happen here at some point is consumers are going to realize the economy is not going in the direction they want. They're going to realize that the Fed isn't cutting rates, that minimum payment isn't going to drop anytime soon, and they're going to be faced with a massive decision, and that's going to be to cut spending and service their debt. When that happens, watch out to what happens with the rest of the economy. We're going to see this minimum payment effect across the credit card spectrum. I'm not making a point here about the low end of the market or even about subprime. No, the point he's making is that when people start making the minimum payment, they're financially strapped. And when they lose their job, they go into delinquency. And then they go into default because they can't get another job. The problem here is, again, at some point, debt service is becoming a priority. When that happens, U.S. economy right into a recession. Credit card delinquencies, meanwhile, continue to tick up. JP Morgan said 2.17% of accounts had balances that were more than 30 days past due in the fourth quarter, up from 2.14% in the year prior. Customers with accounts 90 days past due also edged higher. So again, we see this in relation to the labor market. As people lose their job or they see their wage growth slow against higher inflation, they start to go into delinquency. Delinquency, unless the economy turns around, well, we know, goes right into default. The rise in delinquency rates has been slowing, however, and banks aren't flagging any serious signs of distress. Well, not until it's too late and they ask the government for a bailout. Inflation is also starting to ease and the labor market remains solid. But is the labor market solid? And that's the point of today's show, because what's happening in the UK is a warning to workers all over the world. It's only a matter of time before it hits here in the U.S. Take a look at this. Delinquency rate on credit card loans in blue against the unemployment rate. You can see the relationship here. It's only a matter of time before the U.S. labor market falls apart. Delinquency rates surge, and you can better believe the first people who are going to be asking for a handout, well, it's going to be the U.S. banks. So how, as you can clearly see, the warning that the UK is sending out to the world is, if you think wage growth is good, watch out, because if demand is falling, and you're going to find out that at the same time, people are going to be out of work, and that means your economy, just like ours, is going to be squarely pointed into recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being a fan. Bye now.